Most retail traders are taught a very specific kind of patience. When an asset takes off, the standard playbook says to wait. You highlight the absolute origin of that breakout, sit on your hands, and wait for the price to retrace all the way back to rock bottom before buying. But aggressive, high-momentum markets rarely offer that kind of courtesy. When major capital is driving an asset upward, the price doesn't do a full 100% retracement back to the starting line. This chart shows exactly how the strategy plays out. You see the initial surge, a shallow pullback, and the asset continues its climb. Because the buy zone is anchored at the baseline, the trader misses the upward momentum entirely. Institutional capital operates differently. Instead of waiting for a total collapse back to the bottom, major buyers build hidden accumulation zones right in the middle of an active trend. They pause, consolidate, and create a localized floor before pushing higher. Identifying these mid-trend bases is how you catch explosive market movements. If you only look at the extreme bottoms, you are going to be left on the sidelines while the trend accelerates. We can track these mid-trend floors by looking for a specific structural footprint. It is called the rally-base-rally continuation pattern. This triggers with an initial surge, the rally. The market pauses, printing a tight consolidation candle, the base. A second green candle breaks upward. This base represents institutional accumulation, creating a localized demand zone. When price dips back to strike this box, it immediately bounces higher. The exact opposite occurs during a market crash. A sharp drop is followed by a sideways base where sellers accumulate short positions, and then a secondary drop occurs. This creates a drop-base-drop, a mid-trend supply zone composed of heavy selling pressure. These continuation patterns act as physical barriers embedded within the chart. The demand zones operate as trampolines, catching falling prices, while the supply zones act as heavy concrete ceilings, forcing rising prices back down. But charts do not always print perfect, continuous sequences. When the trading day ends, the world keeps spinning, and overnight volatility can distort these patterns. Major macroeconomic events, an unexpected earnings report, a sudden geopolitical conflict, or an abrupt factory shutdown happen while the market is closed. When the opening bell finally rings the next morning, the price reacts instantly, creating a violent gap in the chart. This requires a rule called exceptional marking. In a standard setup, you draw your zone around the consolidation base candle, but a massive gap invalidates that traditional base. This chart illustrates the adjustment. Instead of highlighting the base, the zone box detaches and snaps directly to the bottom of that gap-up jump. That empty space represents aggressive buying pressure that materialized overnight. The true origin of institutional capital starts at the bottom of the gap, not the previous day's close. Highlighting the old base candle during a gap anchors your trades to a dead area. The institutions have abandoned that price level, leaving any capital parked there entirely undefended. There is a widespread assumption in retail trading that a support floor or a resistance ceiling gets stronger every time the price strikes it and bounces away. The mechanics of capital tell a different story. Institutions operate with finite budgets. They allocate a specific amount of money to defend a particular price zone, and that reserve has a hard limit. This animated chart shows a demand zone in action. Every time price tests the base, capital is deployed to absorb selling pressure. Eventually, reserves run dry. With the budget at zero, price effortlessly crashes straight through the floor. Repeated tests do not fortify a level. They drain the capital, keeping it intact. Heavily tested zones are crumbling dams on the verge of total structural failure. Knowing this, we have to look at the broader landscape. What happens when a market methodically tests and exhausts every single overhead resistance ceiling over a period of months or years? We saw this macro absorption play out perfectly in the global crude oil market. The stakes and capital involved were massive, and charts documented every move. For months, the price action was incredibly choppy, but during that consolidation, the market consistently wicked upward into historical drop-base-drop supply zones. Each of those minor rallies forced sellers to spend their capital to push the price back down, methodically draining their reserves. Then, a major geopolitical catalyst hit the news. The market attempted a sharp rally. Because all overhead supply zones were tested and drained over the preceding months, zero structural barriers were left with the capital to push back. This animated chart illustrates what happens next. This state is called a liquidity vacuum. With the sellers completely exhausted, the price action faces zero friction. It shoots vertically, covering years of upward ground in a matter of days, simply because there is nothing left to stop it. The highest probability setups do not come from guessing where the barriers are the thickest. They come from tracking the absorption of capital and striking at the exact moment those barriers cease to exist.